Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments.
All right, so this is what we're looking at today, the U.S. market peripheral notes from Monday, April 13th, 2026. Let's dive in and see what was really driving things.
This video presents a direct informational narration of the source document.
Okay, so here's the plan. We'll kick things off with the risk disclosure, the important stuff. Then we'll jump into geopolitics, specifically what's happening in Hormuz and how it's affecting volatility. Next, we'll cover market performance and what the big institutions are up to. From there, it's all about the Q1 earnings outlook, including a look at specific stocks on the radar. And finally, we'll wrap it all up with a technical perspective and a summary.
All right, let's get into our first section, the risk disclosure and important notice.
This document is provided solely for informational and research purposes and does not constitute investment advice, a recommendation, solicitation, or an offer to buy or sell any financial instrument. Investing in financial markets involves significant risk, including the potential loss of principal. Prices of equities, indices, derivatives, digital assets, and other financial instruments may fluctuate materially and unpredictably. All strategies, market views, and analytical content are presented for reference only and do not constitute trading instructions, portfolio management guidance, or guarantees of future performance. Any investment decision should be made independently by the reader based on their own financial circumstances, objectives, and risk tolerance. Market conditions, liquidity, macroeconomic developments, policy changes, and unforeseen events may materially affect performance at any time. Past performance and historical analysis are not indicative of future results. Information contained herein may be time-sensitive and subject to change without notice.
Okay, on to Section 2, and this is where it starts to get pretty wild. We're talking geopolitics, specifically the situation in Hormuz and something called algorithmic volatility.
So what's the deal here? Well, basically, negotiations between the U.S. and Iran just completely fell apart. The U.S. had this proposal. They wanted Iran to not only abandon its nuclear ambitions, but also to partner up on a kind of toll station in the Strait of Hormuz. But Iran rejected it. So the U.S. pivoted to a different strategy, not a military blockade, but what they're calling a reverse blockade. It's a commercial enforcement move, really. They're targeting any vessel that tries to pay Iran's passage fee.
And the effect? It was instant. On Monday, the number of vessels in the strait just fell off a cliff. We're talking from 19 vessels down to just 4. That is a huge drop.
And what happens when shipping traffic in a major oil choke point grinds to a halt? Exactly what you'd think. WTI crude prices surged. We're talking a retaliatory jump of 9%. A 9% spike is no joke.
But then, things got even stranger. A social media account posted a rumor about a phone call using keywords like agreement and ceasefire. And just like that, the price of oil came tumbling back down. This had nothing to do with actual oil supply. This was all driven by high-frequency trading models. These HFT systems use natural language processing to scan for those exact keywords. The moment they see something positive, they trigger sell orders. It's creating this wild, non-fundamental volatility that's basically just noise, but it's moving markets in a big way.
All right, moving on to Section 3, market performance and institutional positioning. So, despite all that geopolitical drama, the U.S. markets actually had a really strong session. We saw a low open, high close day, with the S&P 500 finishing at 6,886. Now, a big driver here seems to be the run-up to monthly options expiration this Friday. The bulls are really trying to push things higher, creating a classic short squeeze that's forcing bears to cover their positions. But here's where we see a bit of a disconnect. Let's look at the institutional positioning. You have Citadel talking about a potential ceasefire, JP Morgan is calling for the S&P to hit 7,000, and BlackRock is of course focused on AI-driven growth. Publicly, they sound pretty bullish, right? But their actual market positioning tells a very different, more cautious story.
Yeah, because their derivatives positioning, it points to a deeply defensive stance. The data from the May options chain is pretty clear. These firms are loading up on puts, which, are basically insurance against a market downturn. So while they're talking up the market, they're simultaneously hedging their bets, preparing for a potential drop. It really looks like they're using this rally as a chance to sell into strength.
Okay, let's turn our attention to Section 4, the Q1 earnings season outlook.
All right, so with the Fed likely on hold, all eyes are on corporate earnings, and the expectations are, well, pretty high.
The LSEG consensus is for S&P 500 earnings growth to come in at 13.9%. But get this, the tech sector alone is expected to grow by a whopping 46%, and that means it's contributing about 80% of the entire S&P's growth. The pressure is on for tech to deliver.
And we're already seeing that the market is going to be really scrutinizing these earnings reports. Just look at Goldman Sachs. They actually beat on their top and bottom lines, but the stock still sold off. Why? Because the market was worried about weakness in their FICC division and their credit provisions. So it's not just about the headline number. On the other hand, the tech sector is still seen as the core engine. After pulling back a bit, big names in tech are starting to look attractive again from a risk/reward perspective, assuming they can deliver on those massive growth expectations.
All right, Section 5. Let's look at the single stock earnings radar.
This is a great way to see what the market is thinking ahead of earnings. Just look at the implied volatility. For WIT, it's sitting at 30%, a huge number, which tells you there's a lot of uncertainty there. Then you look at Netflix, and it's only 6%. That's pretty low for them, suggesting the market is fairly confident. For the semiconductors, we're seeing a range of 5 to 7%. Ali Financial is at 5%, and Alcoa is at 7.6%. It's like a map of market anxiety for the week.
And that brings us to our final section, number 6, the technical lens and summary view.
So when we look at the technicals, we're seeing some potential warning signs. There's an indicator called the Magic 9 turn, and right now it's on count 8. For those who follow it, that suggests that this upside momentum could be getting close to exhaustion.
Let's do a quick deep dive on Oracle, which had a huge 12.7% surge. So what happened? Well, first we saw a key moving average breakout. But second, it's now running into some major neckline resistance right around $171. And third, a lot of this flow seems to be driven by short covering, not necessarily new buyers coming in. So the question is whether this is a sustainable move or just a squeeze ahead of the real earnings data.
Okay, so let's bring it all together with a summary view. The market appears to be in a high-level standoff. We have this expiration-related gamma effect providing a floor, while geopolitical risks are creating a ceiling. Risk is clearly accumulating under the surface. So the guidance here is to maintain clinical discipline, avoid chasing these extended moves, and really just wait for the hard data from earnings season to validate the next direction for the market.
We conclude with the professional risk disclosure and important notice. This document is provided solely for informational and research purposes and does not constitute investment advice, financial advice, trading advice, or any recommendation, solicitation, or offer to buy or sell any security or financial instrument. The author is not acting as a registered investment advisor, broker-dealer, financial planner, or fiduciary. No advisory or client relationship is created by the publication or use of this document. Investing and trading in financial markets involves substantial risk, including the possible loss of principal. Prices of equities, indices, derivatives, digital assets, and other financial instruments may fluctuate significantly and unpredictably. All market views, analyses, and discussions are provided strictly for informational and educational purposes. They do not constitute trading instructions, portfolio management guidance, or any form of guarantee regarding future performance or outcomes. Any investment or trading decision made based on this document is undertaken solely at the reader's own discretion and risk. Readers are responsible for conducting their own independent research, verification, and due diligence. Past performance and historical analysis are not indicative of future results. Information contained herein may become outdated without notice.